of top 10 cryptocurrencies a week ago. This video gives price analysis for BTC, ETH, BNB, ADA, Doge, XRP, DOT, Uni, BCH, LTC, the top 10 leading cryptocurrencies in the world. Let's get started. Selling is taking place near key overhead resistance levels in Bitcoin and altcoins, but a shallow pullback could signal that more upside is on the way. The price of Bitcoin rose slightly at the start of this week, but data from Glassnode suggests that new BTC investors who arrived late to the party are panicking and selling their holdings. This shift in crypto assets from speculators and momentum chasers to long-term investors is encouraging. This lays the groundwork for the next bull run to begin, but it may not happen right away. Institutions are unlikely to buy aggressively at the moment, causing the price of Bitcoin to rise, because there is still the possibility of accumulating at low levels. As a result, the range-bound action could last a few more days. According to Forbes, a partnership between New York Digital Investment Group (NYDIG) and enterprise payment company NCR could allow 650 banks and credit unions in the United States to offer Bitcoin trading services to more than 24 million customers. This move is likely to attract a slew of new crypto investors, which is a good thing in the long run. Will Bitcoin and other altcoins face selling pressure and fall below their recent lows, or will buyers push the price higher than the current highs? To find out, look at the charts of the top 10 cryptocurrencies. BTC, USDT. On June 29, Bitcoin broke above the 20-day exponential moving average, $35,196, indicating a positive trend. This indicated that traders were attempting to push the price above the 20-day EMA rather than taking profits at that level. Daily chart of BTC, USDT. The bears, on the other hand, haven't been able to keep the price above the 20-day EMA. This indicates that sellers are defending the area, $37,752, between the 20-day exponential moving average and the 50-day simple moving average. The bears will now try to push the price down to $31,000, but the 20-day EMA is flattening and the relative strength index (RSI) is above 45, indicating that selling pressure may be easing. A small pullback from current levels will improve the chances of a break above the 50-day SMA, paving the way for a rally to $42,451.67. If the bears sink the price below the $31,000 support, this bullish view will be invalidated. This could lead to a reduction in critical support to $28,000. ETH, USDT. On June 29, ETH broke above the 20-day exponential moving average, $2,170, indicating strength. The bears, on the other hand, wasted no time in dragging the price back below the 20-day EMA today. This indicates that sellers are hesitant to give up their advantage. Daily chart of ETH, USDT. The ETH, USDT pair will try to rise above the 20-day EMA once more if the bulls do not allow the price to fall below $2,000. The pair could rise to the downtrend line if this happens. At this point, the bears will attempt to halt the rally. Contrary to popular belief, if the bears manage to push the price below $2,000, the pair could drop back to the $1,728.74 support level. Retesting a support level over and over tends to weaken it. If the price falls below $1,728.74, selling could become more intense, and the pair could fall to $1,536.92. BNB, USDT. The 20-day EMA, $315, is providing resistance to Binance Coin, BNB. The bears will now try to push the price below $264.26, which serves as immediate support. If they succeed, the altcoin could fall to $211.70, which is a critical support level. Daily chart of the BNB, USDT currency pair. TradingView is the source of this information. The negative RSI and downsloping moving averages indicate that the path of least resistance is to the downside. Alternatively, if the price falls below $264.26 again, buyers will try to push the price above the 20-day EMA. The BNB, USDT pair could rise to the 50-day SMA, $369, and then to $433 if they succeed. This level could act as a strong resistance, and if the pair falls below it, it could drop to the 20-day EMA. ADA, USDT. Cardano ADA broke through the 20-day EMA, $1.38, but buyers were unable to keep the price above it. This indicates that the bears are putting forth a strong defense against the resistance. Daily chart of the ADA, USDT currency pair. TradingView is the source of this information. The ADA, USDT pair could fall to $1.20 if the price falls below $1.30. The bulls will most likely buy this dip and try to push the price above the 20-day EMA once more. The pair could rally to the 50-day SMA, $1.57, if they succeed. On the other hand, if the bears manage to push the price below the $1.20 support, the pair may fall to $1. This is a key support to keep an eye on because a break below it could lead to a long liquidation, while a bounce off it could keep the range-bound action going for a few more days. Doge, USDT. For the past 3 days, Dogecoin Doge has been trading near the 20-day EMA 27 cents, but bulls have been unable to push the price above it. This may have prompted short-term traders to book profits, causing the price to fall today. Daily chart of Doge, USDT. TradingView is the source of this information. The Doge, USDT pair could drop to the critical support at 15 cents if the bears sink the price below the 21 cent support. Before panic selling drags the price down to 10 cents, this is the last major support. If the price bounces off the 21 cents support, however, it indicates that bulls are attempting to form a higher low. The buyers will then attempt to push the price above the 20-day EMA one more time. If they are successful, the pair may rise to the 50-day SMA 33 cents, which is just above the head and shoulders patterns neckline. XRP, USDT. At the 20-day EMA 73 cents, XRP's pullback has hit a brick wall. This indicates that traders are selling on rallies to the overhead resistance levels, implying that sentiment remains negative. Daily chart of XRP, USDT. TradingView is the source of this information. The bears are now attempting to push the price below 58 cents. If they succeed, the XRP, USDT pair could fall to 50 cents, which is a psychological level. This is an important support to keep an eye on because if it gives way, the decline could extend to the descending channel support line. If the pair rises above 75 cents from its current level or rebounds from 58 cents, this bearish view will be invalidated. The bulls will appear to be trying to make a comeback if they make such a move. After that, the pair may rise to the 50-day SMA 93 cents and then to $1.07. USDT. Polkadot has retreated from the $16.93 resistance level, implying that bears are selling on every minor rally. The bears will now attempt to push the price down to $13. If the price bounces off this support, the altcoin's consolidation between $13 and $16.93 could be extended. Daily USDT chart. TradingView is the source of this information. The downsloping moving averages and RSI below 38, on the other hand, suggest that the path of least resistance is down. If bears push the price below $13, the USDT pair may enter the next leg of its downtrend, which could take it to $10 and then $7.50. If the bulls drive the price above the 20-day EMA $18.20, this bearish view will be invalidated. This could lead to a move higher to the 50-day SMA and then $26.50. This level is likely to be aggressively defended by the bears. USDT. The bulls were able to push the price above the $18.60 resistance, but they couldn't get past the 20-day EMA $19.49. This indicates that bears are still selling Uniswap on rallies to strong resistance levels. Daily chart of the USDT currency pair. TradingView is the source of this information. The USDT pair could drop to $15 if the price drops from its current level. For a few days, a bounce off this support could keep the pair range bound between $15 and the 20-day EMA. The pair could rise to the 50-day SMA $24.45 if the bulls regroup and push the price above the 20-day EMA. This level may act as stiff resistance once more, but if the bulls can keep the pair above $18.60, the pair could rally to $30. BCH, USDT. The 20-day EMA $537, which is just below the horizontal resistance of $538.11, is providing stiff resistance to Bitcoin Cash BCH. This level is likely to be aggressively defended by the bears. Daily chart of BCH, USDT. TradingView is the source of this information. The BCH, USDT pair could drop to $428.43 and then to $370 if the price falls below this level. For the next few days, a bounce off this support could keep the pair range bound between $370 and $538.11. The 20-day EMA is flattening, and the RSI is above 41, indicating that selling pressure is easing. The pair could gain momentum and rise to the 50-day SMA $690 if bulls push the price above $538.11. LTC, USDT. The 20-day exponential moving average $147 is providing stiff resistance to Litecoin's LTC relief rally. This indicates that traders are selling on rallies to strong resistance levels, implying that sentiment remains negative. LTC, USDT chart on a daily basis. TradingView is the source of this information. If the price falls below the current level, the bears will try to push the LTC-USDT pair below the $118 support level once more. If they succeed, they will have completed a descending triangle pattern. This could increase selling pressure, causing the price to drop to $100 and then to $70. In contrast to this assumption, the bearish setup will be invalidated if the price rises from the current level or rebounds from $118 and breaks above the downtrend line. This may pave the way for a rally to $225. The author's views and opinions are solely his or her own and do not necessarily reflect those of CryptoRelic. Every investment and trading decision entails some level of risk. When making a decision, you should do your own research. Pi Network (Pi) is the newest digital token to catch the cryptocurrency community's interest, even before it has completely debuted. Some users see it as a chance to get engaged in a cryptocurrency from the beginning and profit in the future, similar to how early Bitcoin adopters made huge profits by mining and keeping the coin. Others, on the other hand, have compared Pi to a worthless multi-level marketing (MLM) scheme. Welcome to CryptoRelic. Click on the subscribe to my channel for more updates on any cryptocurrencies. But what exactly is the Pi network and how does it function? Do you know what the Pi cryptocurrency is and want to learn more about it as a potential investment? This video gives an outline of the Pi network's goals and how the Pi cryptocurrency price forecast is already shaping up. Watch the video to the end to know. Pi Network is a digital currency project that intends to keep crypto mining accessible, despite the fact that the centralized nature of the first generation of currencies, such as Bitcoin, has made them inaccessible to the general public. The Pi network, which was created by a group of Stanford grads, allows users to mine currencies using a mobile phone software while also authenticating transactions on a distributed ledger. Phase 1 of the initiative, with its free Pi mining app, launched on Pi Day, March 14, 2019, with branding based on the number. The network had more than 100,000 active members by June 2019, and more than 3.5 million by the time Phase 2 debuted a year later. In May 2020, the app began running advertisements in order to raise funds for the project. In March 2021, the number of users hit 14 million, up from 12 million in February. Picoin is the cryptocurrency that runs on the Pi network, and like other cryptos like Bitcoin, it was designed to be halved on a regular basis to maintain scarcity. When a miner reaches a specific milestone, the number of coins he or she earns for processing subsequent transactions is cut by half. When it hit 100,000 users, Pi's mining rate was halved to 1.6 per hour, then reduced again to 0.4 per hour when it reached 1 million, and finally to 0.2 per hour when it reached 10 million. It will continue to halve until it reaches 1 billion users, at which point it will be zero. Users can volunteer to test the Pi Node desktop software on their PC during the project's current second phase. But when will Phase 3 begin? In 2021, for example? According to the developers, the commencement of the third phase is not set in stone and is dependent on the second phase's progress. Unlike nodes in networks like Bitcoin or Ethereum, which employ proof-of-work protocols, Pi nodes use a stellar consensus protocol-based algorithm (SCP). Pi nodes validate transactions on a distributed ledger and agree on the order in which new transactions are recorded on the ledger. The SCP requires Pi nodes to form security circles, or groups, of 3 to 5 trustworthy individuals known to each of the network's users. Because transactions may only be authenticated on the shared ledger if the trustworthy nodes approve them, security circles create a worldwide trust network that prevents fraudulent transactions. Picoin is still in the pre-release stage. If you're looking to add Picoin to your portfolio, you won't be able to do so right now. Users who have mined the Pi cryptocurrency will be allowed to withdraw or swap their coins only after the project's third phase, when Pi switches to a fully decentralized blockchain. According to the project website, Pi cannot be transferred during the testing phase to avoid phony accounts from accumulating coins. When Pi switches from a testnet to a mainnet, when the blockchain protocol is finished and fully implemented, wallet balances are intended to be honored. As a result, Picoin is now unavailable for purchase on any cryptocurrency exchange or trading platform. Holders will be able to take full control of their private and public wallet keys once Phase 3 starts, and they will be able to use the coin to buy products and services on Pi's peer-to-peer marketplace or swap it for fiat currency. Users cannot transfer or spend their currency unless they have the keys. The Pi mobile app is a Bitcoin wallet that may be linked to a user's phone number or Facebook account. External wallets will be able to hold Pi coins and transact with them by uploading transactions directly to the Pi blockchain, just like other public blockchains. Unlike other blockchains, however, its developers have yet to share the source code. The Pi developers released a new Pi brainstorming app in December 2020, which allows users to suggest app ideas, join projects, and interact with other Pi users. Pi coin is being hoarded by early users in the hopes that the price would skyrocket once Phase 3 goes live. Users can boost their mining rate by connecting with other active miners, despite the fact that the coin's mining rate has been halved. New Pi network members can only join if they have a referral code from another user. The project's creators argue that personal networks improve the security of the Pi network by encouraging users to invite friends and relatives, raising suspicions that it is a multi-level marketing or pyramid scheme. However, unlike an MLM scheme, users can only earn coins from their own direct networks, not from the networks of their friends. Some cryptocurrency watchers have already begun predicting the worth of the Pi network. Let's take a look at what the Pi price will be once it starts trading. Pi network, 2021 to 2025 Pi coin price prediction. The Pi cryptocurrency value is likely to begin at a low level against the US dollar, as with other digital coins, then rise as its usage grows. What do some of the pricing projections imply? Pi network price projection 2021 to 2025, published on March 18 by digitalcoinprice.com, predicted that the coin's price will climb from an average of 0.0107 against the US dollar in 2021 to $0.0127 in 2022, and $0.0212 by 2025. The Pi price is expected to average $0.0319 by 2028, according to the forecast. On March 19, however, the website removed all of the information from its price projections. Meanwhile, Wallet Investor, an algorithm-based forecasting service, predicts a Pi coin price of $0.0132, with a downside of $0.00743. According to crypto exchange Changelly, the bull scenario may see the price of Pi hit $1 if it launches by the end of 2021, depending on the amount of cryptocurrency users and exchanges that embrace Pi. Changelly expects that the price will grow to $5 in the long run by 2025. These are some of the questions that may cross your mind. When will Pi coins be available for purchase? The Pi cryptocurrency is expected to launch during the Pi network's third phase of development. The launch date has yet to be determined. It will be determined based on the results of the testing phase and the following listing on cryptocurrency exchanges. What do you think the Pi value will be? Pi presently has no value and cannot be traded on a stock exchange. Although it is difficult to determine the coin's value before its launch, some forecasts suggest that it will begin with a value of roughly 0.01 versus the US dollar. Will the price of the Pi rise in the future? The popularity of the Pi among cryptocurrency investors will determine the price's trajectory. If the broader cryptocurrency markets continue to strengthen, the price of the coin could grow after it starts, as new projects tend to attract investor attention. Is it wise to invest in Pi coin? Investors are now unable to exchange Pi currencies. You could participate in mining the coin if you expect the initiative to effectively develop an accessible cryptocurrency that does not price out everyday users. You might also wait to purchase it through an internet exchange. Click subscribe button to subscribe to my channel for the next update on Pi network.
Cryptocurrency refers to a type of digital asset that uses distributed ledger, or blockchain, technology to enable a secure transaction. Although the technology is widely misunderstood, many central banks are considering launching their own national cryptocurrency. In contrast to most data in financial economics, detailed data on the history of every transaction in the cryptocurrency complex are freely available. Furthermore, empirically oriented research is only now beginning, presenting an extraordinary research opportunity for academia. We provide some insights into the mechanics of cryptocurrencies, describing summary statistics and focusing on potential future research avenues in financial economics. In 2008, the pseudonymous Satoshi Nakamoto posted a white paper describing an implementation of a digital currency called Bitcoin that used blockchain technology. More than 10 years later, hundreds of cryptocurrencies and innumerable other applications of blockchain technology are readily available. The rise of cryptocurrencies poses an existential threat to many traditional functions in finance. Cryptocurrencies embrace a peer-to-peer mechanism and effectively eliminate the middleman, which could be a financial institution. For example, no bank account or credit card is needed to transact in the world of cryptocurrencies. Indeed, a cryptocurrency wallet serves the same function as a bank vault. With a smartphone and the Internet, the potential exists for a revolution in financial inclusion. Given that over 2 billion people are unbanked, Global Findex, 2017. World Bank, 2017. The technology, however, goes well beyond providing banking services to the unbanked. It holds the potential for cheap, secure, and near-instant transactions, allowing billions of people to join the world of Internet commerce, paying, and being paid, for goods or services, outside of the traditional banking and credit card infrastructure. Cryptocurrencies transactions potentially enable near real-time micropayments. Credit cards are not designed to be used for a 1-cent charge to download, for example, a product or service from the Internet. Cryptocurrency systems promise to make micropayments seamless and allow businesses to offer real-time pay-per-use consumption of their products, such as video, audio, cell phone service, utilities, and so forth. A cryptocurrency like Bitcoin can be thought of as a decentralized autonomous organization, DAO, an open-source peer-to-peer digital network that enforces the rules it is set up with. In this DAO setting, the money supply is set by an algorithmic rule, and the integrity of the network replaces the need to trust the integrity of human participants. The growth of cryptocurrency technology therefore poses a challenge to traditional monetary authorities and central banks, as Facebook's Libra coin pre-emission market acceptance suggests, Taskensoy, 2019. Central banks understand this, and many banks have initiated their own national cryptocurrency initiatives, Beck and Garrett, 2017. As with any new technology, risks are present. In the nascent cryptocurrency market, one concern involves the anonymous nature of transactions in some cryptocurrencies, which could allow nefarious actors to conduct illegal business, or worse, to pose a broader threat to our society and institutions. Foley et al., 2018. The benefits, such as low transaction cost, security and the promise of quick processing, are readily measurable, but quantifying the risks is less straightforward. In our view, any new technology involves risks. If we require no risk, innovation is constrained. Catalini and Garnes, 2016. Cryptocurrencies have, in contrast to many markets, a plethora of available and free data, ripe for empirical investigation. We are just now seeing the genesis of academic research focusing on this emerging technology. Harvey, 2014, 2017a, 2017b, Ardle et al., 2018, Kim et al., 2019. We have 4 goals in this paper. First, we explain the mechanics of cryptocurrencies at a high level. Second, we detail useful data sources for researchers. Third, we provide basic summary statistics given the available data. Finally, we offer a list of possible research applications. 2 Cryptocurrencies and blockchains. The concept of supplementary, Delmolino et al., 2016, alternative, Ametrano, 2016, or digital currencies, Chaum, 1983, is not new, but the concept of an open-source currency without a central point of trust, such as a central distribution agency or state lead control, is new. King and Nadal, 2012. A cryptocurrency is a digital asset designed to work as a medium of exchange using cryptography to secure transactions, to control the creation of additional value units, and to verify the transfer of assets. Many different cryptocurrencies exist, each with their own set of rules. See, for example, CoinMarketCap.com, Iwamura et al., 2014, Abraham et al., 2016, Bartis, 2015, Park et al., 2015. Differences among the cryptocurrencies may involve, for example, the choice of the consensus mechanism, the latency, or the cryptographic hashing algorithms. 2.1 High-level description of blockchain. Abadi and Brunnermeier, 2018, describe a blockchain trilemma, i.e. that no ledger can satisfy all ideal qualities of any record-keeping system, correctness, decentralization, and cost efficiency, simultaneously. Yet, a blockchain is more efficient than a centrally managed traditional ledger. Babick and Hillary, 2018a. A blockchain can be implemented in many ways, but most share several common features. We can think of a blockchain as a very special database. A blockchain structure is shared, or distributed, rather than centralized, and thus is often referred to as distributed ledger technology, DLT. As we discuss later, the distributed network provides some level of security, because it is unlikely an attack can be launched on every copy of the database. Distributed databases are not new, and most distributed databases are not blockchains. The key difference between a regular distributed database and one set on a blockchain is the structure, Babic and Hillary, 2018b. A blockchain is divided into subsheets of data, each one called a block. At the end of each block is a digest that summarizes the contents of the block. The digest is repeated as the first line of the next block. If any change is made in the content of a historical block, the digest changes for that block and it will not match the first line of the next block. When the network detects such an inconsistency, it throws out the corrupted block and replaces the block with the original. In this sense, the database is immutable. Given this structure, i.e., data organized in blocks with updates to the blockchain being append only, based on the respective consensus mechanism, it is extremely unlikely that history can be rewritten. The digest at the end of a block and at the beginning of the next is generated by a cryptographic hashing function. A. Centralized. B. Decentralized. C. Distributed. Hashing a hash function is a one-way mathematical algorithm that takes an input and transforms it into an output, known as the hash or digest. Hashing functions have a long history in computer science and are integral to the blockchain technology. Hashing should not be confused with encryption. With encryption, a file is encrypted with a key and decrypted with a key. Hashing has no decryption step. Additionally, a good hashing algorithm makes it computationally infeasible to find two input values that produce the same hash value, output. This is known as collision resistance. One common cryptographic hashing algorithm, the secure hash algorithm, SHA-256, has a maximum input size of 264 to 1 bit, more than 2 million terabytes, and an output of 256 bits. We usually represent the SHA-256 output in hexadecimal form, also called base 16, the characters 0 to 9 and AF. In order to make the theoretical maximal input size more visual, we assume that 1 bit equals to 1 square millimeter. A soccer field has the dimensions of 7,140 square meters, therefore 264 to 1 bit could theoretically fill 2,583,577,601 soccer fields. As the whole surface of the Earth equals to 510 trillion square meters, we could also cover around 36,170 times the Earth with the theoretical input size. This input information will be stored in a very short output, the hash. If just one piece of the input, like for example a blank space or a comma, is changed, then the hash output be completely different. Importantly, the digest does not reveal the original information. For example, suppose we want to send an electronic document via email, but are worried that the document could be corrupted and the content altered. One way to verify the integrity of the email is to use a hashing function, such as the SHA-256. Before sending the email, we obtain a SHA-256 of the document and post the SHA-256 on our website. We then send the document. The recipient also hashes the document to verify the hash is the same as the hash on our website. If they are identical, we have securely sent the document. Posting the hash on our website does not reveal the content of the email. Blockchains Harbor and Stornetter, 1991, were the first to propose a linear hash chain or blockchain. They solved the problem of how to certify when a digital document was created or last changed by timestamping a cryptographic hash of the document. By not timestamping the data itself, the privacy of the content was preserved. Harbor and Stornetter's timestamping proposal also solved the potential problems of collusion and lack of trust by linking hash values together and using digital signatures, which uniquely identify the signer. A year later, Dwork and Nair, 1992, proposed a proof-of-work system to combat junk email. Their idea was to provide each email with a header containing virtual postage in the form of a single calculation, which the receiver could verify with very little effort. This postage stamp was to be proof that a modest amount of CPU time was expended for calculating the stamp prior to sending the email. Whereas an individual email could be sent at a very low cost, the intent was to defeat spammers, who send millions of emails. Spamming would come at a high price. Back, 2002, coined the term hashcash to describe this proof of work, the computational cost of producing each hash, a term first used by Jacobson and Jules, 1999. Many applications of blockchain technology exist, but we focus our attention on cryptocurrencies. Bitcoin, cryptocurrency known as BTC, was the first example of a digital asset, which has no backing or intrinsic value, based on blockchain technology. Nakamoto, 2008, Biomeal, 2015, for a review. A common characteristic of cryptocurrencies is a network of peers with equal standing. Each participant has a copy of the ledger and offers an algorithmic consent on the correct ledger, i.e., which new block is accepted and which block is rejected to form a new part of the blockchain. It is unnecessary to know your peers in a blockchain or to trust them. It is also possible to design a blockchain so that only specific trusted parties have the ability to add to the ledger. Private, permissioned blockchains are a source of considerable interest for many central banks. In contrast to cryptocurrencies such as Bitcoin, trust is necessary in the permissioned blockchain, because the central banks actually own the coins, i.e., as a governing layer they have the right to change the supply of coins. Any type of transaction, for example, a financial contract for any type of property transfer, can be put into a blockchain. Given its immutability, a blockchain provides an official record of the contract and a single agreed-upon version of the contract, which is unlikely to be disputed. To summarize, a blockchain is distinguished from an ordinary distributed database by its unique structure, which linearly connects smaller pieces of the database, or the blocks. The chaining comes in the form of a cryptographic hashing function. Any change to history will break the chain on a particular copy of the database. When a chain is broken, the network fixes it by replacing any corrupted block with a valid block. Cryptocurrencies are currency without an intrinsic value, such as a cryptocurrency like Bitcoin, can only function if sufficient market acceptance is present and if the belief exists that the currency has the value attributed to it. With a conventional fiat system, money has value because people trust the central bank. For a cryptocurrency, additions to the public ledger are confirmed by a crowd of participants. There is no central bank and participants do not need to trust each other. Trust only applies to the algorithm and the network that defines the particular blockchain. A transaction is only valid if the output is equal to the input, that is, the transactor actually has the funds she or he wants to transfer. The only exceptions are new issues of the cryptocurrency, which are algorithmically predetermined. We have demonstrated the simplicity of creating a SHA-256 hash to link one block to the next. Why is it then that massive computing power is needed to maintain the Bitcoin network? The power required has to do with the proof of work consensus concept. The danger of using a simple SHA-256 is that a nefarious actor could change a historical block and all subsequent blocks, essentially rewriting history, by ensuring all hashes match. To make this unlikely, Nakamoto, 2008, proposed the idea of requiring work. Thus, instead of simply providing any SHA-256 output, a special SHA-256 output, which has many leading zeros, is required. In other words, the proposed SHA-256 hash needs to be lower than or equal to the current target in order for the block to be accepted by the network as the next block to be added to the blockchain. This difficulty ensures that a new block is added on average every 10 minutes to the Bitcoin blockchain, so-called block time. To find this special hash, certain nodes, called miners, will take a candidate group of verified transactions and cycle through numbers, say, 1, 2, 3. Very large number, until the output of the SHA-256 has some leading zeros. This number, which is added to a digest of the transactions, is called a nonce. The computing power requirement arises because the leading zeros are determined via a brute force search. The probability of one leading zero is 1/16, but the probability of, for example, 18 leading zeros is a very small number, 1/16, 18. The search is why the vast computing power is needed. See subsection 2.2. The first miner that finds the, currently, 18 leading zeros, as in our example, presents its group of transactions and the nonce to the network. Verifying that the transactions plus nonce delivers the leading zeros is easy. Once each node verifies the candidate block, the new block is added to the Bitcoin blockchain. This process is the Bitcoin consensus mechanism. The miner that found the winning block is rewarded with freshly minted Bitcoin. If technology advances or additional computing joins the mining efforts in the network so that blocks are being solved in less than 10 minutes, the algorithm adjusts the difficulty to, perhaps, 19 leading zeros. If computing power leaves the network, the difficulty can be reduced. Cryptocurrency mining is therefore analogous to gold mining. Gold mining is expensive. Cryptocurrency miners spend computing power to find the hash as described above. A gold miner only gets rewarded if gold is found. Cryptocurrency miners only get rewarded if they are the first to find the winning hash. Like mining for gold, mining for cryptocurrency is risky. The continuous expenditure of resources such as for hardware and energy, see also subsection 4.9, for a prolonged period without being rewarded is an inherent risk. Proof of work makes it unlikely that a historical block and all subsequent blocks can be altered, but securing the highly specialized computing power needed to rewrite history is not currently likely. Nakamoto, 2008, states that if a single entity gains 51% of the computing power, it is possible. Proof of work is only one approach to consensus. Many alternative mechanisms exist and they may not entail the high equipment and energy costs that Bitcoin miners face. The second leading cryptocurrency, Ethereum, uses a similar proof of work mechanism. Ethereum, however, has committed to change to a proof of stake mechanism, Franco, 2015, ETH, 2018. Instead of allocating block mining proportionally to the relative hashing power, the proof-of-stake protocol allocates blocks proportionally to the current holdings. Buterin, 2014, Cotillard, 2015. As a result, the participants with the most cryptocurrency are particularly incented to do the right thing to keep the system running and healthy. Such a method holds the promise of much improved latency and substantially less energy consumption. A participant who possesses 1% of the cryptocurrency could mine 1%, on average, of the proof-of-stake blocks. Ethereum has a number of other differences from Bitcoin. Ethereum blocks are added approximately every 14 seconds rather than every 10 minutes, and importantly, Ethereum allows for smart contracts, or small computer programs, to be deployed in its blockchain. These smart contracts are run redundantly on each node. Many other consensus mechanisms are currently available. STEEM's proof of brain rewards participants for creating and curating content in their social network, Steam.io Bluepaper, and Slimcoin's proof of burn bootstraps one cryptocurrency off another by demonstrating proof of having burnt some units of value by sending a specific amount to a verifiable unspendable address, Slimcoin whitepaper, or different implementations of the Byzantine fault tolerance, which was first described as the Byzantine generals problem by Lamport et al. 1982, are used by systems such as Neo, Stellar, and not all cryptocurrencies are the same. We can group cryptocurrencies into 7 broad classes. Bitcoin falls into the first category. It was originally designed as a transaction mechanism. Think of it as Gold 2.0. Litecoin is very similar to Bitcoin and was one of the first alternatives to Bitcoin. Litecoin's blocks are added every 2.5 minutes, on average, compared to every 10 minutes for Bitcoin. Ethereum falls into the second class, a distributed computation token. As mentioned earlier, it is possible to run a computer program on the Ethereum network. Think of it as an internet computer where small programs, smart contracts, are executed when called upon, on every node. Other examples in this class include Tezos, EOS and Dfinity. The third class of cryptocurrency is called a utility token. A utility token is a programmable blockchain asset. One example is Golem, a currency that allows the user to buy computing power from a network of users or to sell excess capacity to others. Storj is similar and allows the user to rent out unused disk storage. Other examples in this class are SIA and Filecoin. The fourth class of cryptocurrency is a security token, a token that represents stocks, bonds, derivatives, or other financial assets. New security token offerings are called STOs. This type of token could lead to substantial efficiency gains in both clearing and settlement. The fifth class is called fungible tokens. The most popular is called ERC20, which is issued on the Ethereum blockchain. Here a small amount of ETH represents something different, and more valuable. A non-fungible token is the sixth classification. In this case, each token is unique and not interchangeable with another. One popular protocol is Ethereum's ERC721. Drama debt agreements fall into this classification. Two other impools of non-fungible tokens are CryptoKitties and Decentraland, Land. The final class of cryptocurrencies are called stablecoins. There are four categories. The first category is collateralized with fiat currency. This includes stablecoins such as Tether, USDT, and Circle's USDC. These cryptocurrencies are designed to be fully collateralized by US dollar deposits. LBXPEG is tied to pound sterling. An emerging market, Mongolia has a cryptocurrency called Candy tied to their currency. This class also includes national cryptofiats. As mentioned earlier, many central banks are investigating the potential Fedcoin, US Federal Reserve, Eurocoin, European Central Bank, CAD coin. Bank of Canada, for example. Venezuela already issued a national crypto called Petro. The second category of stablecoins are collateralized with real assets. Examples include currencies that are collateralized by gold, Digix Gold, DGX, a basket of 7. Precious metals used in technology, Tiberius Coin, TCX, or even Swiss real estate, Swiss Real Coin, SRC. The third category of stablecoins are cryptocurrency collateralized. The leading example is the collateralized debt positions that Maker DAO offers that enable their DAI coin to be pegged to the US dollar. The final category of stablecoins are uncollateralized. An example of this type of initiative is the Basis project and their Basecoin, which has been put on hold given regulatory concerns. This list of classifications is not exhaustive because many cryptocurrency concepts, such as overlay or Facebook's Libra, do not easily fit within our 7-category taxonomy. Our point is simple. Cryptocurrencies have many uses and characteristics that extend beyond the traditional cryptocurrencies of Bitcoin and Ethereum. 3. Summary analysis of cryptocurrencies. We will now focus on an econometric analysis of the currently most liquid cryptocurrencies. Valuation of currencies that are not collateralized or linked to real assets is a challenge. These currencies are highly volatile and subject to bubble-like behavior. These currencies, however, provide an ideal testing ground for economic theory. In the fall of 2017, Bitcoin rose to over $19,000. The bubble burst in 2018. Because every Bitcoin transaction is freely available, we are provided with an extraordinary research opportunity. We begin with a simple benchmarking analysis using the S&P 500 index, S&P 500, SPDR Gold Shares, Gold, and CBOE Volatility Index, VIX, which measures the implied volatility of the S&P 500 index. 3.1 Cryptocurrency data sources. Many, sometimes very generic, data sources are available for cryptocurrencies, which, unlike traditional assets, trade 24/7. creating a vast amount of data to capture. Blockchain-based systems, most of which are open to the public for participation, have data that are readily available using basic APIs, Application Programming Interface. Point 1 in subsection 4.3, we discuss Exchange APIs, which provide the data for actual cryptocurrency market transactions. Guo and Li, 2017. Several of the more important data sources include CoinGecko, a cryptocurrency ranking and evaluation site that breaks down quantitative and qualitative data for a number of different metrics, as well as CoinMarketCap, OnChainFX, CryptoCompare, BitInfoCharts, CoinCheckup, and CoinCodex. Each has unique attributes. 3.2 Statistical overview of cryptocurrencies. While there are thousands of cryptocurrencies, we focus our analysis on three: Bitcoin, BTC, Ethereum, ETH, and Ripple, XRP. To represent traditional assets, we have chosen S&P 500, Gold, and VIX. Each cryptocurrency has a different implementation. Some, like Litecoin, are very similar to BTC. As previously mentioned, ETH allows for distributed computation. In contrast to BTC, ETH may be easier to value because it has a tangible component, i.e., running a computer program on a network. XRP focuses on the banking sector with the promise of fast and secure transfers of tokens, whether in fiat, cryptocurrency, commodity, or other unit of value, across different networks, geographic borders, and currencies. Aranda and Zagon, 2015. The Ripple system's efficiency and security challenges the traditional SWIFT system for transfers, which is now also interested in blockchain-based technologies. Arnold, 2018. In Figure 2, we show the cumulative return over time for BTC, XRP, ETH, SPDR Gold shares and S&P 500 from May 1, 2017 to June 30, 2019. We chose this short time period because, prior to this, the cryptocurrency market was substantially illiquid. It was not until 2016 that the initial influx of exchanges and users entered the market. By May 2017, all three cryptocurrencies were active and had achieved sufficiently high market capitalizations. Although BTC has the highest market capitalization and had received intensive media exposure prior to our sample period, this time period allows us to capture both the liquid trading period and the full sample of ETH and XRP in addition to BTC. Potential research areas. Cryptocurrencies, as a new type of asset, offer many research opportunities for financial econometrics. For example, research on the dynamics of cryptocurrency trading, pricing, and volatility forecasting is advancing at a rapid pace. Briere al. 2013, Gronwald, 2014, Cheng al. 2015, Fry and Chayar, 2016, Chan al. 2017, Kim al. 2019. We will focus on the areas of network design, sentiment, and valuation, monetary systems and financial development, institutions, adoption, price discovery and high-frequency data, index construction, portfolio diversification, bubbles, alternative methods to raise capital, and the role of energy in consensus mechanisms. 4.1 Network design, sentiment, and valuation. The acceptance of this new technology has risen rapidly and activity in cryptocurrency trading has led to the establishment of more than 200 highly fragmented, mostly unregulated cryptocurrency exchanges, which act more like broker-dealers than traditional exchanges. Hansen, 2018. There is considerable off-chain trading. This might be intrabroker trading, matching, or even dark pool trading, which might lead to price jumps at exchanges. Sharma, 2018. More types of cryptocurrency are being traded in parallel, on different exchanges, with different prices. See subsections 3.1 and 3.2. These parallel information sources yield dynamic high-dimensional interdependencies. Robinson et al. 2019. Introduce a cross-chain technique which allows transactions to be executed and their respective value to be validated across sidechains. They outline a programming model of a swap contract for exchanging value between sidechains, and discuss how this technology can be readily applied to many blockchain systems to provide cross-blockchain transactions. A major problem for blockchain applications is the respective network's scalability. Bu et al. 2019. Research a distributed ledger system run by targeting algorithms that ensure a high throughput for the transactions generated in Internet of Things (IoT) systems. Transactions are continuously appended to an acyclic structure called tangle, and each new transaction selects as parents two existing transactions, called tips, that it approves. This new metamorphic algorithm for tip selection by approving left-behind tips, and improving confidence within the main tangle, offers the best guarantees of both constructions called IOTA and its proposed improved version G-IOTA. A number of papers study the economic incentives of current consensus methods. Huberman et al. 2017. Biash et al. 2018. Model the proof-of-work blockchain protocol as a stochastic game and analyze the equilibrium strategies of rational, strategic miners. They show how forks can be generated by information delays and software upgrades, and identify negative externalities. Easley et al. 2018. Investigate the role that transaction fees play in the evolution of Bitcoin from a mining-based structure to a market-based ecology. They develop a game-theoretic model to explain the factors leading to the emergence of transactions fees, as well as to explain the strategic behavior of miners and users. They highlight the role of mining rewards and trading volume, and examine how microstructure features such as exogenous structural constraints influence the dynamics and stability of the Bitcoin blockchain. Kong et al. 2018a. Develop a theory of mining pools that highlights risk sharing as a natural centralizing force. Bamwani et al. 2019. Research if cryptocurrencies have an intrinsic value related to the network's computing power and network adoption. Their hypothesis is motivated by the fact that miners expend real resources to generate the computing power required to secure and operate the blockchain. An optimally performing blockchain serves as a medium for transactions and attracts users, developers, and intermediaries, thereby leading to an increase in the cryptocurrency's network size. They find that there is a positive and statistically significant relationship among price, computing power, and network size, adoption levels respectively, which can be used to construct asset pricing factors. Ong et al. 2015. Use social media data and find 4 key variables related to the market capitalization of a cryptocurrency. 1. Merged pull requests on GitHub. 2. Number of merges. 3. Number of active accounts. And 4. Number of total comments. The biggest cryptocurrencies by market capitalization experience the most activity, which is to be expected. However, the collection of this information is unique to cryptocurrencies. In the equity market, for example, similar information can be gleaned from third-party sources, like analyst reports and recommendations, and perhaps news flow and conference calls. The different sources of information available for cryptocurrencies presents new opportunities. Research on trading patterns, herding effects, and economic decision-making has started on sentiment construction, projection and cryptocurrency-specific lexica. Natural language processing techniques in combination with other machine learning techniques allow researchers to build sentiment measures. Critterola and Figuer-Talamanca, 2017, propose a confidence-based model for asset and derivative prices in the Bitcoin market with prices influenced by measures linked to the confidence in the underlying technology. Aster, 2018, studies the dependency and causal structure of the current cryptocurrency market and investigates the collective movements of both prices and social sentiment related to almost 2,000 cryptocurrencies traded during the first 6 months of 2018. His results uncover a complex structure of interrelations, in which prices and sentiment influence each other across different currencies both instantaneously and with lead-lag relations. Nasekin and Chen, 2019, study investor sentiment on cryptocurrencies using a cryptocurrency-specific lexicon proposed in Chen et al. 2018b, and statistical learning methods. Accounting for context-specific information and word similarity by learning word embeddings, They apply natural language processing methods for sentence-level classification and sentiment index construction. They argue that the constructed sentiment indices are value-relevant in terms of its return and volatility predictability for cryptocurrency market indices. See subsection 4.5. Pagnotta and Burashi, 2018, also address the valuation of cryptocurrencies, and characterize the demand for bitcoins by the available hash rate and show that the equilibrium price is obtained by solving a fixed-point problem. They find that price hash rate spirals amplify the demand and supply shocks. Schilling and Ulrich, 2018, analyze the coexistence and the competition between the USD and Bitcoin. They analyze Bitcoin price evolution and interaction between the Bitcoin price and monetary policy which targets the USD, and obtain a fundamental pricing equation, which in its simplest form implies that Bitcoin prices form a martingale. 4.2 Monetary systems and financial development. Blockchain-based monetary systems hold the potential to impact the macroeconomy, as the new payment systems challenge the traditional roles that banks have always played. Cryptocurrencies may be viable competition for fiat currencies during periods when a central bank is perceived as weak or untrustworthy. However, the technology behind cryptocurrencies has the potential to improve a central bank's operations and can serve as a platform to launch their own cryptocurrencies. Raskin and Yamak, 2016. The Petromondia, Petro, issued by the government of Venezuela is an early example of these so-called central bank digital currencies, CBDC. Keister and Sanchez, 2018. On June 18, 2019, Facebook announced to release a cryptocurrency on its own in 2020 coined Libra. Central authorities were fast to criticize this step and governments, including the United States, France, the United Kingdom, Germany, and Japan, expressed their resentment and skepticism. However, the propagation of systemic banking crises fostered by too big to fail financial institutions' never-ending propensity to take greater risks was a compelling reason behind the birth of cryptocurrencies over a decade ago and the design of Libra with its governance network of 28 high-profile firms already being in the project, looks similar to the Board of Governors of the Federal Reserve System comprising the 12 Federal Reserve banks in the United States, with the difference of being in the hand of private actors and not a government. Taskensoy, 2019. Almasova, 2018, studies the economics of blockchain currency systems and the respective value competition by applying a matching function of money demand to the operation of a blockchain to observe a monetary equilibrium. With cryptocurrencies already substituting for fiat money, Hendry and Zhu, 2017, model the coexistence of different types of transactions and show that monetary authorities' coordination capabilities are being restricted by the use of non-regulated cryptocurrencies. The Catalini et al. 2019 paper on a market design for a blockchain-based financial system provides an extended abstract on a theory of long-run equilibrium in blockchain-based financial systems. Their theory elucidates the key market design features that separate proof-of-work and proof-of-stake approaches in the long run and when each design might each be appropriate. See subsection 2.4, and conclude that with weak relational contracts or substantial concerns about outside interference, proof-of-work designs may be preferable. With regions that have local institutions that are reliable enough to make delegation feasible, proof-of-stake designs can lead to efficiency gains and improvements in governance. Cryptocurrencies may also increase financial inclusion and fuel economic activity in emerging markets, especially in sub-Saharan Africa, where only 34% of adults had a bank account in 2014. Blockchain Africa Conference 2018. blockchainafrica.co. Global Findex, 2017. World Bank, 2017. The possibility of using this technology for inclusion of the unbanked could allow billions to join the modern world of Internet commerce and spur the creation of new businesses. 4.3 institutions. There are 100 of cryptocurrency exchanges around the world. Some of the best known are Binance, Bitfinex, Kraken, Bitstamp, Coinbase, Bitflyer, Gemini, Itbit, Bittrex and Poloniex. Each of these exchanges has its own specific traits. Kraken claims to be the largest Bitcoin exchange in EUR volume and liquidity, as well as being a partner in the first cryptocurrency bank, collaborating with the German BaFin-regulated bank Fedor. Shapeshift, in contrast, is an exchange that allows trades without signing up for an account. Gemini, being a fully US-regulated and licensed Bitcoin and Ethereum exchange, met its capital requirements by placing all USD deposits at a FDIC-insured bank. CoinMarketCap lists 218 exchanges, but even the measurement of trading volume is controversial. A recent filing to the SEC, 2019, argues that 95% of the trading volume in Bitcoin is fake. The research identifies 10 exchanges with actual volume, out of 81: Binance, Bitfinex, Kraken, Bitstamp, Coinbase, Bitflyer, Gemini, Itbit, Bittrex and Poloniex. Due to the large number of exchanges with an ever-increasing number of cryptocurrencies, price discrepancies due to market inefficiencies inherently exist. The low level of regulation and sentiment-driven prices make pricing discrepancies larger than in other financial markets, such as fiat currency exchanges and stock exchanges. However, when one goes outside the 10 exchanges with credible volume, some of the price discrepancies may not be real. Bistarelli et al., 2019, show via a theoretical model and via an empirical strategy that arbitrage opportunities are possible by trading on different exchanges. Critarola et al., 2017. Their approach is complementary to other theoretical studies on Bitcoin arbitrage such as Barker, 2017, or Peters and Vivanco, 2015, where the researchers study triangular arbitrage with Bitcoin, i.e., buying Bitcoin in USD and selling them in RMB. Makarov and Shaw, 2018, observe large recurrent arbitrage opportunities in cryptocurrency prices relative to fiat currencies across exchanges. These opportunities often persist for several days or weeks, and the price dispersions exist even in the face of significant trading volumes on many of the exchanges. Makarov and Shaw find that spreads are much smaller when cryptocurrencies are traded against each other, suggesting that cross-border controls on fiat currencies play an important role in creating the arbitrage opportunities. By constructing a common component and an idiosyncratic component, they conclude that the order flow plays an important role in explaining the spreads between exchanges. Further research in regards to arbitrage in Bitcoin markets is done by Krukerberg and Schultz, 2018. Bistarelli et al., 2018, show that cryptocurrency arbitrage strategies are profitable because the exchanges have different prices in the short run. Indeed, the fragmentation of exchanges is ideal for high-frequency trading bots. Bloomberg, 2017, reports that Chinese high-frequency traders have used algorithms to identify mispricings and arbitrage opportunities across numerous exchanges in China. However, later in 2017, China banned all cryptocurrency exchanges. Och et al., 2018, note that consensus protocols confront traders with random waiting times until the transfer of ownership is accomplished. This settlement process exposes arbitrageur to price risk and imposes limits to arbitrage. They derive theoretical arbitrage boundaries under general assumptions and show, by using high-frequency Bitcoin data, that these increase with expected latency, latency uncertainty, spot volatility, and risk aversion. They conclude that settlement through decentralized systems induces non-trivial frictions affecting market efficiency and price formation. 4.4 Adoption, Price Discovery and High-Frequency Data Kong et al., 2018b, provide the first fundamentals-based dynamic pricing model of cryptocurrencies and platform tokens, taking into consideration the user base externality and endogenous user adoption. Because the expectation of token price appreciation induces more agents to join the platform, tokens capitalize future user adoption, generally enhancing welfare and reducing user base volatility. Socken and Shung, 2018. Catalini and Garnes, 2019, show that entrepreneurs have an incentive to use subsequent product pricing choices to ensure that crypto tokens issued to fund startup costs, a subject we discuss in subsection 4.8, retain their value even when they do not confer the typical rights associated with equity. Athi et al. 2016 develop a theoretical framework for Bitcoin adoption and Bitcoin pricing. Their paper relates to a variety of broad themes in the study of information technology adoption and usage. Cryptocurrency prices. The launch of Bitcoin futures on both the CME as well as the CBOE, XBT, provides opportunities to study price discovery. Karkinen, 2018. Bitcoin futures trading gives many institutional investors the ability to invest in Bitcoin and also allows to settle contracts in fiat money, potentially boosting liquidity. Currently, the Bitcoin futures volume is approximately the same as the largest exchange, Binance. Almost all of the volume is in the CME contract. The CBOE has announces they will no longer offer a Bitcoin futures contract. Scalability et al. 2018 identify high-frequency jump components in the Bitcoin market and link them to new information arrival over time. Guo et al. 2018 perform a spectral clustering analysis of dynamic return-based network structures with coin attributions. This latent group structure in the cryptocurrency market leads them to conclude that comovements are influenced by the type of algorithm used. Makarov and Shaw, 2018, study price deviations across cryptocurrency exchanges and interpret the deviations as the result of a balance between idiosyncratic sentiments of noise traders and the efforts of arbitrageurs to equilibrate prices across exchanges. 4.5 Index construction poses unique challenges when it comes to cryptocurrencies. Traditional indices, such as the S&P 500 or Russell 3000, gather data from stocks that are traded over particular time intervals in a small numbers of venues. Cryptocurrencies are traded 24/7 on hundreds of venues, like World Coin Index, CoinMarketCap, CryptoCompare, Cryptocurrency Index 30, or the CME/CF cryptocurrency indices. Preliminary research on index construction is made, for example, by Trimborn and H. Ardell, 2018, Chen et al. 2018a, and Kim et al. 2019. Thanks for watching.